Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. We are seeing significant signs that the labor market today is rapidly deteriorating, while the unemployment rate itself is still near historical lows not seen since the 1970s. We are seeing signs underneath the surface that this is not going to last long, and it's going to have significant repercussions in the coming months on the economy and the financial markets. The unemployment rate is the biggest indicator of the economy. It determines how strong the economy is, how deep a recession is. This is why 2008 is considered to be one of the worst recessions in financial history, because the unemployment rate climbed up to 10% in a very short amount of time. It's also why the Great Depression was considered to be the worst financial crisis in history. You can see in 1929 here, the unemployment rate near 0%, then climbing up to 25% by 1932, and staying above 10%, 10 years, a full decade, where 1 in 10 people could not find a job. So I'm going to be making a complete overview of the signs that we are currently seeing, that the unemployment rate is about to surge here. If you enjoyed this video, don't forget to click on the like button and of course click on that subscribe button if you are new here. Now, without further ado, let's get right into it. So let's begin by taking a look at initial claims here. So this is the number of people that have filed for unemployment insurance in a given month. And this is actually a moving average of a 2-week chart. So it's a 10-week moving average of the initial claims. And you can see what's been happening very recently is we've had a surge in initial claims. Now, this is a surge that's coming off very low levels, of course. But if we add recession bars here to indicate where we've had recessions throughout recent financial history, you can see the surge that we're getting is similar to what typically happens before a recession. You tend to see initial claims begin to rise, often off multi-decade lows. You get that initial thrust off the bottom before actually entering a true recession. You can see here 1973, 1969. So this happens right before a recession. I'm going to show you more evidence in this video that we are likely to see this worsen. And in just a minute, we're going to take a look at what typically happens to the stock market in these instances where you've already had initial claims begin to rise. Now, another very interesting chart is the unemployment level of permanent job losses. So this does not include temporary layoffs. And you can see that's been starting to climb higher in March of 2023. You clearly have the unemployment level rising for the first time since COVID. Now, COVID was, of course, a fake recession in the sense that it was precipitated by global shutdowns, and central banks immediately stepped in with very aggressive, easy money to hold up the economy throughout that period. So if we exclude that, this is really the weakest labor market we've seen since 2007. Before that, since 2001. Again, the last 2 recessions we've had. Now, if we put this on a year-over-year basis, you can see unemployment is now officially, for the first time in March of 2023, weakening on a year-over-year basis. It was incredibly strong here throughout 2022, a very strong labor market, and now it's weakening here. And you can actually see that unemployment is rising on a year-over-year basis. Again, first time since COVID. Before that, 2007. Before that, 2001. And that seems to be happening with lots of momentum here. Now, do we actually have proof that this is not going to be like previous instances where you just briefly had this type of contraction, like in 2017 and 1996, where you had some weakening of the labor market, but then eventually it stabilized and remained strong for years after? And if you know your stock market history, you'll know that 1996 to 2000 posted incredible returns. Same thing between 2017 and 2019. Strong stock market throughout that period. One chart that supports the idea that we are going to see more weakening ahead is this one, is the chart of AAA investment grade bonds against the Fed funds rate. And you can see that is inverted for the first time since 1989. Even in 2007, it was not inverted. Now, what does inversion mean? It means that the yield that you get for holding a AAA rated bond is less than the yield you get for just holding a government-backed short duration bond that basically yields the same amount as the Fed funds rate. So that makes absolutely no sense. Even though AAA rated bonds are the highest quality rating, it's still a riskier investment than holding short duration bonds that are backed by the central bank. And you can see when that does happen, it typically happens for a very short period of time, and that's often followed by a recession. You can see that was also the case in 1969, in 1971, in 1979. Here, every single time that this goes below zero, it leads to a recession. And now another data point that we recently got was the leading economic indicators data. Now for the month of March, it shows us leading economic indicators continue to contract very severely. Now notice that if we look at coincident economic indicators, they are not yet reflecting that weakening economic data. This is why stocks really haven't crashed yet. This is why we haven't seen the unemployment rate rise. It's why we haven't seen the stock market move down yet, because coincident data has remained quite resilient. We haven't seen the type of deterioration in economic data that you usually see during a recession like 2008, like 2000, like 1989. We're still very much in positive growth territory. If you compare to real GDP, there's actually nothing wrong with what's happening right now in terms of coincident economic indicators. But you look at leading economic indicators, they're telling a much different story, and they just continue to get worse month after month. So if we come back to this chart that we were talking about in the beginning of the video, and we compare these instances right here that look similar to today in terms of initial claims bumping up from low levels before recession, which again we've proved out in this video is a likely scenario here. Let's add the S&P 500 on top of this chart, and you can see here in 1969 that marked the beginning of the capitulation move down. In 1973, it marked the beginning of a much larger move down in the market. In 1989, it was right before the 1990 bear market. Here in 2000, of course, right near the top, right after the top, and same thing in 2007. Again, if the macro environment deteriorates from here, you're not going to see stocks rise. The only time that did happen was in 1979. We've discussed this before on this channel. PE ratios in 1979 were at 7. Let that settle in. Right now, the PE ratio is above 20. So the stock market is almost 3 times more expensive than it was in 1979, which is the reason why you did see stocks rise despite a recession, in fact, 2 recessions, and a record amount of inflation throughout that period. So, of course, we put our money where our mouth is. We have a model portfolio on our website that represents exactly what we're thinking about the market right now, what we're anticipating right now, the best bets that we can make right now with weighted conviction, taking into account the potential reward, the potential risk. And we want to be extremely transparent about our performance. We post portfolio reviews that look at the track record since the inception of the model portfolio every single month, looking at all our bets and their performance against the S&P 500. If this is a service that you would be interested in, make sure to click on the link down below and start out your free trial. So I hope that you guys found this video useful. If you did, make sure to leave a like down below and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.